Section 1. Hook. If someone handed you $1,000 today and said, "Put it in the stock market," would you know what to do? Most people don't. And that's not their fault, because nobody teaches this in school. In the next 10 minutes, I'm going to give you the exact foundation that took me years to figure out, completely for free. Stay till the end, because the last tip alone could save you thousands of dollars. Section 2. What is the stock market? So let's start from zero. What actually is the stock market? Think of it like this. Imagine your friend opens a pizza restaurant. It's doing great, but to expand, he needs $100,000. He doesn't have it. So he splits the business into 1,000 equal pieces, called shares, and sells each one for $100. You buy 10 shares for $1,000. Now you own 1% of his pizza business. If the business grows and becomes worth $200,000, your 10 shares are now worth $2,000. You just doubled your money. That's exactly how the stock market works. Companies like Apple, Tesla, and Amazon do the same thing, just on a massive scale. Section 3. Why invest? Now, you might be thinking, why not just keep my money in a savings account? It's safe, right? Here's the problem: inflation. Every year, inflation eats away about 3 to 5% of your money's value. So if your savings account gives you 1% interest, you're actually losing money in real terms. But historically, the U.S. stock market, specifically the S&P 500, has returned an average of about 10% per year over the last 100 years. Let me show you what that means in numbers. If you invest just $200 a month starting at age 25, by the time you're 55, you could have over $400,000. That's the power of compound interest. You're not just earning on your money, you're earning on your earnings. Section 4. Key terms you must know. On camera, slightly faster pace. Before you invest a single dollar, you need to know these 5 terms. Let's go fast. Term 1. Stock/share. A piece of ownership in a company. Simple. Term 2. Index. A collection of stocks tracked together. The S&P 500 tracks the top 500 U.S. companies. Think of it as a report card for the whole market. Term 3. Bull market versus bear market. Bull market. Prices are going up. Bear market. Prices are going down. Bulls charge forward. Bears swipe down. Easy to remember. Term 4. Dividend. Some companies pay you just for holding their stock, called dividends. It's like rent income, but from stocks. Term 5. ETF, Exchange Traded Fund. Instead of buying one stock, an ETF lets you buy a basket of hundreds of stocks at once. Great for beginners, lower risk. Section 5. How to actually start. Step 1. Choose a broker. A broker is the platform where you buy stocks. For beginners, I recommend Fidelity, Charles Schwab, or if you're outside the U.S., Trading 212 or eToro. All have zero commission on stocks. Step 2. Open an account. Takes about 10 minutes. You'll need your ID and bank details. Everything is online. Step 3. Start with an index fund or ETF. Don't pick individual stocks yet. Buy something like VOO, which tracks the S&P 500. You instantly own a small piece of 500 companies. Safe, diversified, proven. Step 4. Set up automatic investing. Most brokers let you auto-invest every month. Even $50 or $100 is enough to start. Consistency beats timing the market every single time. Step 5. Never panic sell. The market will go down, sometimes 20, 30, even 40%. This is normal. The people who stay invested always come out ahead long term. Section 6. Biggest beginner mistakes. Before I let you go, here are the 3 biggest mistakes beginners make. Avoid these. Mistake 1. Trying to time the market. Nobody, not even Warren Buffett, can consistently predict market tops and bottoms. Stop trying. Just invest regularly. Mistake 2. Putting all money in one stock. If that company fails, you lose everything. Diversify. Spread your money. Mistake 3. Investing money you can't afford to lose. Always have 3 to 6 months of living expenses saved in cash before you invest. The stock market is for long-term money only. Section 7. Outro and Che. That's it. You now know more about the stock market than 90% of people your age. Remember, you don't need to be rich to start. You don't need to be an expert. You just need to start. The best time to invest was 10 years ago. The second best time is today. If this video helped you, drop a comment below telling me one thing you learned. I read every single one. And if you want my next video on which ETFs to buy in 2026, make sure you're subscribed so you don't miss it. I'll see you in the next one.